Hi, my name is Miranda from Provident Credit Union. Thank you for joining us today for our webinar where we will be discussing getting ready for life after college. This webinar is being recorded. All participants have been muted, so please use the Q&A box for any questions. All attendees will receive a follow-up email with today's recording and presentation deck within a week. Your presenter today is Jeff Lackey. He is the Director of Relationship Management at Sallie Mae. And with that, I'd like to now hand it off to Jeff. Welcome, Jeff.
All right. Well, thank you, Miranda, and welcome everyone for joining. I appreciate taking time out of today to learn about this topic. There's a lot of information that we'll be covering today. However, hopefully, if fingers crossed and such like that, because this is life after college, hopefully some of this information is information that you've heard before, and that this is designed hopefully to kind of be a refresher of some of the features and benefits, rules and regulations, and some of the benefits and such that are provided to you as you transition from college and into the next phase of your life, whether that be starting your career or if you're going to be pursuing graduate school or whatnot. Gives you some ideas as to what you may have borrowed as far as student loans in the past, or for your current schooling that you've been attending. And then also too, if you decide that you want to move on with additional higher education, maybe a graduate or professional degree, obviously some of the things that you can kind of keep in mind, and how that pertains to the loans that you've already accrued. We'll kind of touch upon some of that. So anyways, let's go ahead and get started. So today we're going to be kind of discussing both the private and the federal loan programs. I'm not going to be talking about anything specific regarding a specific lender or so. We'll be kind of talking a little bit more in generalities. That way there it pertains to everybody out there. If you've happened to have borrowed a private loan, let's say, for instance, through Safe Credit Union, in partnership with Sallie Mae, or if you've had only federal student loans and such, this will obviously be a refresher of the types of loans that you received. They are two different types of loans, so I will specify as I go through the presentation when I'm talking about private loan features and benefits and things to think about. And then obviously also too, I'll transition and make sure I specifically talk about federal loan features and benefits as well. So you might be asking yourself, okay, he's going to talk about these two different types of loans, but what are these loans? I can't really remember what I had. I remember just accepting them on my financial aid offer and maybe doing some paperwork, but I wasn't quite sure which one is which. So if you have borrowed a federal student loan, you basically, what you did is you borrowed directly from the federal government, the U.S. Treasury. This loan will typically have fixed interest rates, and you would have had to file the free application for federal student aid, which is also known as the FAFSA. You would not have been eligible to receive a federal direct subsidized loan, or maybe even sometimes an unsubsidized loan, without filing the FAFSA first. So that would have been one of the requirements. Now, the nice thing about the federal loans is that you just simply needed to file the FAFSA, not be in default or delinquency on any other type of federal aid option that is available to you. And you must be matriculating at least half-time status or above. So you need to be passing your courses and matriculating and attending school at least half-time status. If you have done that, then you are eligible for a federal direct loan. If you filed the FAFSA and it was determined that you had need, meaning that the costs of the university minus any financial aid, need-based financial aid that you received, as far as like grants and scholarships are concerned, if you had eligibility and need after that, then you could have potentially received a subsidized student loan. Or if you did not happen to have need, or you had just only a little bit of need, and then the rest of it had to be awarded under a non-need basis, you could have qualified for an unsubsidized direct student loan. So Those are the ways and the various types of most popular federal student loans that you could have received. Private student loans are going to be a bit different. They are supplied by a bank or a lending option, credit union, fintech, such like that. They could potentially have variable or fixed interest rates. And again, I'm talking in generalities and not specific to the Safe Credit Union partnership with Sallie Mae. Whereas these loans had your option, whatever worked best for you. Sometimes a private lender may possibly only offer variable. Sometimes they may only offer fixed. Sometimes they can let you choose and see which works best for you. Because these are credit-based loans, you would have a, creditworthiness check or some type of credit scoring mechanism to determine your eligibility and approval for this loan. And if you potentially were applying for this loan and didn't think that you had enough credit, or maybe you had maybe some oopsies in the past where you weren't able to qualify on your own, you may have potentially needed a cosigner for this loan in order to get yourself approved. A cosigner being somebody that is jointly responsible for repayment of this loan. So again, I mentioned on the previous slide that we had talked a bit about subsidized loans and unsubsidized loans in the federal direct student loan program. The subsidized student loans, again, were available and eligible for undergraduate students that had financial need. And one of the benefits on this type of loan, if you did demonstrate need while you were in school or any other type of eligible deferment, the interest is paid for by the federal government. And again, you need to be going at least half-time status in your school. You do have a grace period, which we'll talk about here in an upcoming slide, what a grace period is. But while you're going at least half-time status in school, as well as your 6-month grace period, the federal government and in any future eligible deferments, of which being in school is the most popular and most widely used deferment, you would have this interest subsidized by the federal government. If you did not have needs, so basically when you applied for the FAFSA, you received a cost of attendance from a school, your either expected family contribution or your SAI, student aid index number, one of the two, depending upon when you were attending school. If that number subtracted from the cost of attendance did not allow for you to have what was considered need, then you potentially could qualify for a non-need-based unsubsidized loan. It is the same direct loan program with the same interest rate, same repayment benefits, same repayment terms, all of that. The two differences being that it is a non-need based loan, which means that you don't need to demonstrate need to receive it. And the second being that you are responsible for the interest at the time of disbursement moving forward. So from that standpoint, if you received an unsubsidized loan in your first year of school, let's say 4 years ago or so, and you received your first disbursement in fall, you started paying interest on that first disbursement at that time, or accruing interest, I should say. You started accruing interest at the time on that first disbursement. And then when your spring disbursement came for your spring term, you then started paying or started accruing interest on that particular one, as well as the previous one for fall is still accruing and moving forward from that standpoint. So that is what a non-need based loan would be. So if you are in graduate school, or if you are thinking about attending graduate school, you're moving from undergrad to grad, there are two types of loans that were federal loans that were eligible for graduate students. Again, you had the direct unsubsidized loan program, which was very similar to the undergraduate unsubsidized direct loan program. The only differences being is that there are different loan limits for graduate students in the unsubsidized student loan program. So therefore, because in part the lack of need-based aid, as well as some of the increased costs that come with graduate programs, there were larger yearly aggregate limits as well as total aggregate limits in the program. Graduate students also had available to them, or if you are thinking about graduate school right now currently, you have eligible to you what is called a direct graduate plus loan. Now, this loan is different than the direct unsubsidized loan. If you have taken out this loan before, it is only available to graduate students. You do not need to show financial need, very similar to the direct unsubsidized loan. However, the two distinct differences between the graduate plus loan and the unsubsidized direct loan is that, like I said, there was yearly limits, borrowing limits on the unsubsidized direct loan. With the graduate plus loan, it was whatever your cost of attendance minus your essentially any type of need-based aid that you had received. So from that standpoint, it was basically the cap that you could borrow could potentially be up to the total cost of attendance. Um, with this loan, you were required to start into repayment, but you could defer it while you were in school. Both of them do have grace periods, which we'll talk about what grace periods are coming up in a bit. But the Graduate Plus loan, similar to the direct unsubsidized loan, is a non-need-based loan. And again, from that standpoint, the student was responsible for the interest at the time of every disbursement, and interest would accrue on each disbursement moving forward. So private loans are going to be a bit different. Private loans are a loan that is specifically designed for college financing, but yet it is using private capital. Again, capital that either comes from a bank, a credit union, or a fintech or something along those lines. It does not rely on the federal government. It does not also require the FAFSA either. So if you don't remember filing a FAFSA, but yet you know you have student loans, chances are you may have taken out a private student loan to fund your education. Because these loans are offered by various different lenders, each lender can have their own features and benefits, their own repayment terms, their own interest rates, their own fees, all of that stuff. So you're going to have to check your promissory note and details and contact your loan servicer if you have questions in regards to various different things within your loan. Again, if your loan was co-signed, you do have the potential with these types of loans to have your cosigner released. And we'll talk a little bit more about this again in an upcoming slide. But essentially, a lot of lenders, or some lenders, I should say, offer what is called a cosigner release option. So if after you graduate, you make a specific number of payments, let's say on time, you may also need to have a credit worthiness check taken out on your behalf or some sort of a credit scoring mechanism in order to determine that you're eligible to take on this debt by yourself. If it happens to be, let's say, for a loan that cosigner release option is available at 12 months after you have finished school and made 12 principal and interest payments, then you can apply to have your cosigner released, which means that the cosigner, if approved, would not be obligated to be co or jointly responsible for the repayment of this loan afterward. So again, it's a nice feature to have on a loan if you did need to happen to have a cosigner in order to get you approved while you attended school. So where are we right now? Right now, currently, since I'm not quite sure exactly where everybody is in the audience, but I'm assuming that some of you may have either just graduated or you're getting close to graduating right now. You had just finished school or you are just getting ready to finish school. If so, chances are you have had your payments deferred while you're in school, which means that you have not had to make any payments while in school unless you chose to do so. You are getting ready to enter into what is called your grace or your separation period. A grace or separation period is a period of time after you leave school that allows for you to do whatever, relocate, interview for a job, get established, set up residency, and whatever the case may be. And typically for federal loans, it's 6 months that you have a grace period. And with many private student loan lenders, they do offer a grace period as well, and it can range anywhere from 6 months and up if they decide that they want to offer that. So right now, currently, chances are, if you've just finished school, you are currently entering into your grace period. Once that grace period is up, however, though, you will be responsible for making principal and interest payments until that loan is paid off. Now, I did mention most of your payments were most likely deferred while you were in school. But if you willingly or specifically chose to enter into repayment while you were in school, and remember, repayment doesn't necessarily need to be principal and interest. It could just be paying the interest only while you're in school, or maybe even opting for making a fixed rate payment, let's say 20 to 25 bucks a month. You wanted to take care of a little bit of interest, get into a good repayment habit of making a monthly payment, and that's what you chose to do. Then that means that you've been making payments while you've been in school, paying the interest monthly or paying this fixed amount monthly. If when you enter into your grace or separation period, you will be obligated to be making those same payments of interest only or fixed amount only while you were in your grace period. But similar to the students that had everything deferred, when that grace period is over, you do enter into making principal and interest payments until that loan is paid off. And again, quick little shameless plug here that if you were taking care of your interest or if you were paying a fixed amount while you were in school, your loan period, repayment period is going to be shorter and you would be ultimately paying less in interest because you were taking care of it while you were in school. So, again, you may have quick questions as to what grace periods are. Again, a grace period is time for you to plan before you have to jump into making principal and interest payments on your loans. Very rarely will you find in other types of lending situations, auto loans, mortgage loans, all of that, that you're really going to have any type of a grace period. It's decently unique for the education market. So, take advantage of it. You do not get penalized by using your grace period. It is a benefit that you have, and certainly take advantage of it if you wish to do so. It is granted to you automatically. You do not have to file for it. Um, if you have already, let's say, been going to school, but you had to leave school for a period of time, and that period of time that you had left school was longer than 6 months, you may have used up your grace period on those particular loans at the time. So again, you'll want to work with your servicer or so just to verify how long your grace period is. But if you've never left school and you've been attending at least half time or above, on your federal loans, then you still have that grace period obligated to you. And again, you don't get penalized for using it. Your principal amount, I mentioned that on the previous slide. You may be saying to yourself, what is the principal amount on a loan? The principal amount on the loan is what you borrowed plus any unpaid interest that has been added to it. And of course, the interest is the amount that you're charged for borrowing that money. So from that standpoint, you may have borrowed $5,000. The initial principal balance you borrowed is $5,000. Then every month that interest is accruing, that interest can either be added to the principal if a lender capitalizes monthly, or that interest could accrue separately from the principal and then be added to it at a particular time, let's say either at repayment or at a fixed date in the future. Those are the two differences between principal and interest. Interest capitalization, I mentioned it just on the previous slide. That is when the interest that is accruing on the principal of your loan actually gets added to the principal amount of the loan. So if you've borrowed $5,000 and you are accruing interest on a monthly basis, and let's say that you accrue $25 a month, hypothetically, we're just making up a number here. Then at the end of 4 months, you would have $100 in interest that has accrued on that principal balance of $5,000. Now, some lenders, including the federal government, has a period or time that they will add that principal to or add that interest to the principal. When they take that $100 and they add it to the principal, that is the interest capitalization period. So then what happens is when that $100 is added, you now owe $5,100, and interest the next month, month five, is now accruing on $5,100, not $5,000. So the more often that a lender, whether it be the federal government or a private lender, the more often that a lender capitalizes interest, the potential you have for paying more interest because your principal is now growing each time that they calculate interest on that principal balance. For most loans in the education sector, interest capitalizes closer to, let's say, repayment. So your principal and your interest typically will stay separated until you enter into repayment, of which they will then be combined and interest will be capitalized, and it will accrue on both the principal and the interest when you enter into principal and interest payments. Some lenders can offer what is called repayment incentives, incentives being essentially benefits or benefits to you for doing whatever. You may get an interest rate reduction as a repayment incentive if you sign up for, let's say, auto pay, where you have a checking or savings account that allows for you to, or allows for the bank or the credit union or the servicer to take your monthly payment directly out of a checking or savings account. In order for that to be automated and such, sometimes a lender will offer an interest rate reduction for that. If you have, in particular, private loans that you may have borrowed through other entities or so, separate from the federal government, you may have some benefits and repayment incentives that are based on your eligibility, maybe a credit union membership, for instance, or something like that. Or you may have a credit to loan balance, which means that after making a certain amount of payments, let's say 48 payments on time and in full, you might get a cash repayment towards your overall debt, or you might get an additional interest rate reduction. Those are some of the repayment incentives that sometimes can be offered by lending institutions. So again, I won't go over this picture too much, but this basically describes what interest capitalization is. We talked about it on the previous slide. If you borrowed, in this particular case, $20,000, you can see that the interest accrued on $20,000 is roughly about $6,597 before you enter into repayment. When you enter into repayment, and let's say over a 10-year repayment period, that $20,000 plus the $6,597 that was added to it at, let's say, capitalization at repayment, then what will happen is interest will now be accruing on $26,597 moving forward. Now, of course, you'll be making payments, and that overall principal balance will eventually start going down more and more. But you can see that you would pay an additional $12,061 in interest on that particular loan. If on the right side of the graph, you had been paying your interest while you were in school, and let's say, again, on $20,000, let's say it was $100 in interest a month that you were paying, hypothetically, then when you entered into principal and interest payments at the end of your grace, you would only have roughly $9,097 that would accrue on that $20,000 balance over 10 years, roughly a savings of just a little under $3,000 by taking care of the interest while you were in school. And in so doing, by paying the interest in school, you have stopped that interest capitalization quicker. And so from that standpoint, you pay less in interest over time. So you may be saying to yourself, okay, I'm getting ready to repay. I understand what grace periods are and such like that. But I need to still figure out where my loans are and such like that. If you need to, if you can, if you have paperwork or if you have an electronic file of screenshots or electronic correspondence via email or text or so that's going back and forth, make sure that you keep track of whether you have federal or private loans. And then document that information as to who the servicers are and how you would contact them in the future if you needed to. Make sure that you gather all of your loan documents. Hopefully, you've been doing this and keeping them in a specific file or a location. But if you haven't, now would be a great time to do so. And then, make sure that you find out, when those loans are going to enter into repayment. Again, if you've borrowed federal loans while you've been in school, federal direct subsidized or unsubsidized loans while you've been in school, you've got a 6 month grace period with those. You've got a 6 month or more grace period with many of the private student loans that are offered by lenders out there. Graduate plus loans don't typically have a grace period, so you may be finding yourself entering to repayment soon after you graduate with your graduate or professional degree. But again, write all of those down, know which ones are which, and when you potentially could be starting to have to make payments. If you say to yourself, well, I think I have all the paperwork, but I think I might be missing something, you can go to studentaid.gov, and you can see it there on the slide. Studentaid.gov is the central area that has all of your federal student loan information. It will have your subsidized and your unsubsidized student loans. It will have your graduate plus loans, all of that, all of the federal loans that are in your name should be housed at federalstudentaid.gov. Go out there, go click on manage your loans, and it will show you all the various different loans that federal student loans that you've borrowed over time. If you have either a mix of federal student loans and private loans, or if you've only borrowed private loans for your schooling, there is no central repository like studentaid.gov. And again, because you've got multiple lenders coming forward that offer various programs and such. And so you essentially have to work with that specific lender or servicer in order to get your information. You may say to yourself, where would I go to do that? I know I've got private loans, but I'm not sure where, and I don't really have my paperwork. You can always go back to your financial aid office and ask them to pull a list, but you can also go out to a credit reporting system. We have highlighted here in purplish pink, annualcreditreport.com, but any credit reporting service that you want to use should have your private student loan information out there. So I would certainly get a hold of them, or certainly pull that report, get a hold of the servicer, and get some documentation on those loans. But that would be where you would find your private loans in the future. So, when you are entering into repayment on federal student loans, you do have some options. Are you planning let's say you're graduating undergraduate school with your bachelor's degree? Are you planning on going to graduate school? You'll have to ask yourself that. Do you plan on working in a field where you may qualify for public service loan forgiveness? So basically, are you going to be working for an eligible nonprofit that over a certain amount of time, roughly 10 years, that you may potentially have partial to all of your federal student loans forgiven if you work for a qualifying public service facility. And again, studentaid.gov will have all of that information out there, and also to give you some good guidance as to what type of nonprofits qualify for this forgiveness program. Do you need a repayment plan that is a little bit different? Let's say that you're graduating with your bachelor's degree, and the position or career that you've started in has you maybe a portion of an internship, or maybe you're starting a little bit lower in the salary range than you thought that you were, and it's not commensurate with the type of salary that you need in order to make your payments fully in a standard repayment term. Within the federal student loan program, there are various different repayment plans available, and some of them will take into account the income that you're earning and assign a percentage of that income to what you would need to pay while in school, typically much less per month than you would on a standard term. So, and again, you can go out to studentaid.gov, go to manage your loans, and you can look at the various different repayment plans that are available. And you can, if you are logged into your profile, you can actually load your federal student loans into the manage your loans section, and it can help you get a sense as to what your payments would be, either in standard repayment form, extended repayment, graduated repayment, or any of the income deferred plans, where essentially they take a percentage of your percentage of your income, and assign a repayment term for a period of time to help you get on your feet. And hopefully, over time, you may qualify, or may be able to earn a little bit more salary or so. And then at that time, you can then start back into standard repayments. You may want to consolidate your loans, or you may want to refi or refinance your loans. I would take a look at the information about consolidating your federal student loans out on the federal student aid website of studentaid.gov, and see if that's something that's attractive to you. But again, remember, anytime that you consolidate a loan, you're going to be changing some of the aspects on that loan. So if you have federal student loans and you like the plan that you're on and such, make sure that that is all going to be available to you if you decide to consolidate those loans. If you have private loans or if you have a mix of federal and private loans and you have been contacted about refinancing your loans, give careful consideration to keeping your federal student loans out of a private refinance model. Now, again, you can choose to do whatever you wish, but remember that the federal student loan programs are specifically designed for students with specific and very attractive student and repayment benefits that if that debt was paid off and reassigned to a new private refinance program, all of those benefits and features and repayment incentives and such would all disappear under the federal student loan program. So certainly consider, whether you would want to put your federal student loans in with your private student loan refinancing. And you can certainly Google pros and cons of doing so, make your own decision, but I'd certainly give careful consideration to keeping your federal student loans out of refinance. So, kind of with that, again, any of the information that you want to go and review at a later time, studentaid.gov has got a lot of information on some of the options and repayment terms and such that you have for your federal student loans. So, tips on how to organize your loans. This shouldn't, really be too difficult. Make sure that if you've got any of your promissory notes, promissory note is going to be it's a snapshot in time of when you took out your student loan. It's going to have all the rules and regulations. It's going to have the information, the interest rates, all of that at what was going on with your loan at the time that you took it out. It's probably, if not the most important, but one of the most important documents that you should keep. This could be in either paper form or it might be available to you electronically. Disclosure statements. They're another statement that is very, very good to have. This is a disclosure statement basically talking to you and finalizing some of the benefits and features that were agreed upon when you accepted the loan, as well as gives you information about each of the disbursements potentially that have gone out. So it's great to keep those as well. Federal student programs require schools, universities, and colleges to send out annual debt letters, as well as lenders have to send out annual debt letters so that you know what you've borrowed, how much interest has accrued, what your estimated monthly payment would look like if you started into repayment at that particular time, so on and so forth. Keep all of those. It's a great way to keep yourself up to date as to where your current balances are. And then, of course, open and read any of your student mail and email. If you've got an email that you've had ever since middle school, and you receive 200 emails a day, of which 199 of them need to be junked, you may want to consider setting up a more professional email and communicating that out to your various lenders and servicers. And also, too, you can use that new professional email maybe for job interviews and some other stuff moving forward. But that way there, nothing should get lost in any of your junk folders or get lost in a large inbox, because some lenders are going to require on communicating with you electronically only. So make sure that you are opening and reading all of your regular mail as well as your email. And then, of course, if you do decide to leave from school, and you're relocating back home to your hometown, or you're moving on to where your new career is starting, make sure that you notify all of your lender servicers of any names and address changes. Keeping those numbers handy, keeping them in your contact list or so is a great way for you to update everybody to your new information that you have, new address or new name. So, if you haven't done so already, consider downloading the app of the various servicer or servicers that you may have on your loans. Again, you can choose to do how you interact how you want, but mobile apps are becoming very popular. They're easy to, hopefully, fingers crossed, and easy to navigate, and should be able to help you keep track of your student loans much easier than just relying on phone calls and or screenshots of various things that you've seen in the past. The app can come in very handy with managing your debt with any questions that you have in the future. So some of you might be saying to yourself, I already know where I'm going to go to work. I've already been given a job offer, and with that job offer, I've got a little bit of extra money coming in the form of a bonus, a signing bonus, or something along those lines. I would like to have a little bit of extra money go towards my monthly payments. Or I got some graduation presents. I don't plan on traveling. These presents were monetary, and I would like some of that to go to my balances. For the federal student loan programs, there are no prepayment penalties. So if you want to throw extra payments towards your loans at any given time, or if you're in an opportunity where you can pay off all of your loans immediately, there are no prepayment penalties. For some lenders out there, they do not have prepayment penalties as well. But again, because each lender can have their own specific private loan program, you'll have to check with them and make sure that they don't have prepayment penalties either. But most entities out there would welcome extra payments and or having that loan paid off without any prepayment penalties. In so doing, if maybe a year from now you get extra money and you don't want to put it anywhere else, either investment or savings or into your normal budget, anytime that you want to put extra money towards your loans, even if it's just 1 month out of every year, you're able to do so. When you do make a payment, payments are going to be done specifically in a specific way. Again, all federal loans, there are no prepayment penalties or anything like that. However, with both federal and private student loans, most lenders will have your payment go towards any particular fees first. So if you have any origination fees outstanding or disbursement fees outstanding, or if you have any late payment fees, for instance, let's say 30 days came and went, you didn't make your payment, and you got assigned a $25 late fee or something like that. When you do make your payment, that payment will go towards any outstanding fees first. Then it will go to interest, and then lastly, it will go to principal. When you look at an amortization schedule of your payments, so let's say a 10-year repayment term of $200 a month or so, hypothetically, if you were to look at the amortization schedule, which is exactly what you're paying each and every month, you will see that the majority of your payment is most likely going to go towards interest first, with a very small percentage of your payment going to principal. And that's probably going to look that way for a few years, where the interest or your payment, the majority of it is going to interest for a while. But then somewhere, maybe a third of the way into the program, you're going to see that the principal amount of money that you have from your payment is going to start taking a larger percentage, to the point that once you're maybe halfway, year five of a 10-year repayment, that the amount of money that you have in your payment going towards principal has increased significantly, as well as the amount of money you have going towards paying the interest has decreased considerably. Then from year five to year 10, you will see that most likely some period of time within there, you will have more of your payment going towards principal and less of it will be going to interest. So it will feel a little odd having so much of your payment going towards interest first, but that's typically how it works. And sometime within your repayment period, that those percentages will start to balance out a little bit more, as well as increase going towards principal than interest at a certain time. So, um, when you're talking about your debt, there are sometimes two approaches on how to make a payment. Sometimes folks like to do what is called the snowball approach. So what you do is, let's say you have 3 to 5 loans, for instance, and they have varying different balances. What some people like to do is pay off all the smallest balances first, That way there, they can go from having 5 student loans down to maybe only owing 3 student loans because they paid off 2 of them, which were very small balances. They paid them off. They don't have to worry about them anymore. No monthly check or no monthly payment that they need to make. And then they can just focus on the 1, 2, or 3 loans that they have left from that moving forward. That is called the snowball approach, where you essentially try and get rid of the smallest balances first. The avalanche approach is where you look at the 3 to 5 loans that you have and not necessarily looking at the balances of each of those 3 to 5 loans. Rather, what you're doing is you're looking at who has the highest interest rate, for instance. So even if, let's say that your largest loan of $10,000 and all the other loans are down around $2,000 to $3,000, if your $10,000 loan has the highest interest rate, then what you're going to do is concentrate on trying to pay down that highest interest rate loan fast as possible. Now, again, remember, you will most likely have to be making monthly payments on all of your loans. But if, again, you have the ability to put extra payments towards something, you, in the avalanche approach, would put those extra payments towards your highest interest rate loans. So just kind of a philosophy on how you want to do. Each way is whatever way works best for you. On average, the avalanche approach will end up saving you a bit more money because you're attacking the loans with the highest interest rates first. But again, it's what works best for you to help keep you and keep your peace of mind level while you're making your payments. On a previous slide, we talked about some repayment incentives. And one of those repayment incentives that lenders offer is what's called an auto debit benefit. And we talked a little bit about it briefly. But some of the benefits of going with auto debit is by setting up a payment so that would come directly from a one of your checking or savings accounts. What it does is it allows for you to either potentially get an interest rate reduction, again, a repayment incentive. A lender could potentially give you a repayment interest reduction, let's say of 1/4%, for instance, or maybe 0.5% off your interest rate if you sign up for auto debit. So there's a benefit right there, is that you're accruing less interest over time. The other thing too is that if you have the lender be responsible for auto debiting your payment each and every month, you should not incur any late fees. All you simply need to do is make sure that there's money in that particular account at the time that the lender is going to debit that payment from your account. And the lender will have a program that it will happen each and every month on the same day, roughly at the same time. Now, if that day happens to fall on a weekend or on a holiday, for instance, that lender will have an auto debit policy as to when they will make that payment. Or when they will debit that payment, I should say. So you'll want to make sure that you know what that is. But as long as you have money in your account, 2 to 3 days ahead of schedule of when they're going to take that payment, you should not be responsible for any late fees or so. If for some reason there's a electronic deficiency or there's a power outage or something along those lines, typically the lender will be responsible for making that or debiting that payment at a later time when they have the ability to do so. You would not be responsible, nor would you be charged late fees for that. Also, too, you'll save time. You don't have to sit down at the table and organize making a payment. You don't have to call into a automated service in order to make that payment or whatnot. It will happen each and every time at the same time. And you just simply need to make sure that you have money in the account. And if you know when you're getting paid by your employer or when you're able to transfer money in, that's all you simply have to worry about. We talked about cosigners at the beginning. Cosigners, again, are folks that allow for you to maybe get approved on a loan, or if you did get approved, but you decided you wanted to add a cosigner in order to try and get a better interest rate. Cosigner is somebody that is going to be jointly responsible for the loan. If you have not talked to your cosigner in the years that you've been going to school, but now that you're entering to repayment, you may want to consider touching base with your cosigner. You want to remind them that you are you're responsible for this loan, that you have the ability to pay this loan. This is the steps you're taking to interview, or this is the job that you've secured, whatnot. It's always great to reinforce that aspect that you are going to try and take care of this loan yourself. It's great to get them set up with their own online access. They do have access and should have the ability to look in on this loan at every time, see when payments are being made. Because again, if for some reason you're not, you don't want this to be a surprise to your cosigner. And in so doing, cosigners have a lot of access to in order to be able to see this loan. So it's always beneficial, as well it is their right, so that to be able to see where that loan is and at any given time. So if your lender that you borrowed from as on the private loans should have the ability for the cosigner to create electronic access. So if by chance something happens, let's say that the job process doesn't look as favorable, or maybe you have lost a position temporarily or so, not only communicating with your lender is a good thing to do to understand why or what could potentially be going on with your loan payments, your monthly loan payments, but also touch base with your cosigner as well. Keep them up to date as to what's going on, because again, they certainly don't want to start receiving letters from the lender or the servicer that is basically saying the actual borrower is delayed or delinquent on their loans. Work out a plan so that they know what's going on first before they just start getting notified by the lender. So we talked about deferment options a bit. Both the federal student loan programs and private student loan programs have deferment options. Again, studentaid.gov will have all the deferment and forbearance options on your federal student loans, and then communicating with your private lenders on their various different deferment and forbearance options as well would be great to touch base on. But again, most of you are taking advantage of a deferment while you're in school. That's the in-school deferment. But there's also military deferments. There's also economic hardship deferments and such that the federal government offers. If again, you start to find yourself maybe not able to make your payments, go out to studentaid.gov, see what your options are. There are options out there, and explore them and see which one works best for you. Same thing with private student loans, like I mentioned. Many lenders will have some sort of process by which they would want to hear from students or applicants, borrowers, if they happen to be having trouble making their monthly payments. Some lenders may have stronger deferment and forbearance provisions than other lenders because, again, it's specific to each lender. So you'll want to familiarize yourself with what your lender offers in the deferment or forbearance fields. But again, you'll want to contact them, find out what that is, or refer to your promissory note. Again, your promissory note should have information about what deferment and forbearance provisions are available to you. I'm not going to talk about specific tax deductions, but I am going to just mention to you that there are tax deductions available through the IRS for student loan interest. And because these policies and such sometimes differ from year to year, what I want to stress is that if you would like to see what they are, go out or Google, go out to either irs.gov or Google Publication 970. Or you can certainly talk to a tax advisor and see whether or not your student loan interest will qualify for a tax deduction. And so again, because some of these rules and regulations can change prior to the income tax filing season, I don't want to give you misinformation, because they sometimes could be finalizing some of those plans and those changes now for the 2025 filing season. But yes, if you just want to go out and look at Publication 970, bookmark it to maybe take a look at it in the first week in January of 2026, or talk with a tax advisor, you should potentially have some potential tax deductions that you can have for your student loans. So lastly, in wrap up, make sure, I think the most important thing to do is stay in contact with your lender and your servicer. If you do happen to move, stay in contact with them, give them your updated phone numbers, updated names, updated addresses, all of that. You don't want to become delinquent on your student loans simply because they were trying to contact you and they were contacting an old address. And because of all of the hustle and bustle of getting a new job and getting a new place to live and all of that, you forgot that you had obligations to make your payments. Read all your statements. Again, it might be a bit of a chore. It might be a bit boring, but make sure that you read them. Most lenders are contacting you for some reason. And so you'll want to make sure that you keep a file of any paper mail or keep an electronic file, an email file for any communications that lenders have with you electronically. And then lastly, anytime that you have any questions, contact your loan servicer, whether it be the federal government, whether it be a private lender or private servicer or so, contact them at any time. And also too, most all programs out there would like to see the borrower be proactive if they're running into some sort of trouble or circumstance. If you reach out at before you're in trouble, lenders sometimes can have better options for you than if you are calling or they happen to get a hold of you because you've already become delinquent. Now a lender has to be reactive. And so from that standpoint, sometimes that's where penalties and fees, the lack of ability to put you in a particular program might occur, all of that. Lenders want to get paid. And they want their money back, whether it be the federal government or it be a private lender. So the best way in ensuring that is to try and also work with you when times become a bit tough. So with that, Miranda, I'd like to go ahead and open it up for questions.
Doesn't look like we have any questions as of now. Um, so that concludes our webinar today. Thank you all for attending, and I hope this session was helpful to you. As a reminder, we will be sending you a follow-up email with today's presentation, and we hope you have a great day. Thank you, Jeff.
Thank you.